I still think we're not out of the woods, and to the extent I foolishly continue to imagine that the fundamentals should have some dictate in the direction of asset prices. I think that this is probably a rally to be sold.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here with another bi-weekly catch-up with our great friend of the show, Stephanie Pomboy. Stephanie, how you doing today?
I'm great, Adam. Thank you so much for having me. It's always fun to be with you, and every week feels like we're starting a whole new era, doesn't
I know,
it?
I know. I mean, the old Lenin quote about, there are decades where not much happens, and then there are, years where decades worth of activity happens. I mean, seems like we've compressed that into a daily basis now, where there are days where years worth of activity happens.
Yeah.
So yeah, going 2 weeks in between these things, it feels like we're going dog years in between.
I mean, we're jumping over so much stuff because there's so many news stories that hit in that time, but then they fade away and they're replaced with new news stories. So it's probably just as good that we're not wasting a lot of time and energy keeping on top of every single story because they disappear as quickly as they emerge, it feels like.
Right. And it's crazy because these are big stories. And I don't even know. Are
Yeah.
we going to talk at all about the Elon Trump meltdown? Are
Uh,
we going to talk about the big, beautiful bill? Are we going to talk about the LA riots? Are we going to talk about some of these trade deals that are trying to get struck? I mean, there's just so many big things going on right now. But let's start with a question I've been asking a lot of folks recently was the correction that we saw in March and April, was that, and then the recovery that we saw in May, was the May recovery just a sneaky bear market rally that's trying to suck everybody back into the markets and then pull out the rug from beneath them, or was the March April decline just a correction in an otherwise still intact bull uptrend, right? And past couple of weeks, I think people have argued both sides of it. Increasingly, I'm hearing, no, I don't think it was a bear market rally. I think we're going to new highs from here, et cetera. And there definitely seems to be a growing optimism on Wall Street for sure
yeah.
that the bullet has been dodged and we're back on the train, to just inexorable, higher and higher asset prices from here. So, Steph, did we, were recession fears overblown? Did we avoid the recession?
Well, this is your softball pitch down the middle for me, Adam. Thank
Yep.
you for throwing me an easy one. Well, to the extent that I thought all along that the consumer was in recession before Trump took office and before the whole tariff tantrum and the big sell-off in April and the rebound in May. So pretty much my answer is I still think we're not out of the woods, and to the extent I foolishly continue to imagine that the fundamentals should have some dictate in the direction of asset prices. I think that this is probably a rally to be sold. That said, I don't know that I wouldn't be running in right now and shorting it like crazy because, as you and I briefly talked about before we jumped on this, some of the technical things look like you could see this move a little higher before you get one last blast off and then um, uh, things revert back to earth. But I'm not a trader, so I prefer, as you know, to look at the big picture and step back. And just broadly speaking, fundamentally, nothing has changed. We started the year without any tariffs. We went through this tariff tantrum, and now we're trying to figure out what the new playing field is. We'll emerge from it with some level of tariffs on some of our trade partners, if not all of
Mhm.
them. So at a minimum, that's going to be a headwind for either corporate profits or the consumer, should corporations be able to pass those price increases along, which, as you and I have talked about prior, I'm highly skeptical about. I think it's more of a profit margin story. But so there's that headwind. But the biggest headwind of all is just interest rates. We've seen, as you noted, this risk on fervor in the markets, where the stock markets gone back up, done a nice U-turn. The VIX has collapsed and credit spreads have narrowed dramatically. But the 10-year yield has done nothing. It's just, it pretty much just moved in a sideways line for the last several months in the face of stronger growth, weaker growth, you name it. It doesn't seem to matter. We have this kind of, I hate to use the phrase, a new normal when it comes to treasury yields. Um, so I think that for me is it's the only indicator I really care about, because when you're running an economy that's levered, it's the only indicator that really matters. That's really important to me, I think. And obviously, if the 10-year yield, if we were having this conversation and the 10-year yield were 3%, I'd be significantly more inclined to say, yes, we're out of the woods. We probably dodged a bullet, et cetera, et cetera. But that's not the case. So while it's nice to see credit spreads narrowing, the fact that nominal yields are kind of just steady as she goes is a problem for all the reasons you and I have discussed at length in prior conversations.
Let me ask you this, Steph. So I'm going to use a word I haven't used in a while, which is lag effect, right? So, what I hear you saying is you've got a lot of confidence in the fact that there will be a lag effect from these higher bond yields, because they act as gravity on economic activity. And the higher that yields go and the longer that they remain high for longer, that is going to eventually have a lag. It's going to express itself negatively in economic growth. Um, how much of your current concern is belief that these things are going to happen at some point, they're going to matter at some point,
Mhm.
versus hard data that you're actually seeing,
Right.
saying, oh, this hard data actually is going the wrong direction.
Yeah, no, it's a fair point. It was back in 2023 when the Fed first started raising rates, it was all a belief that the higher rates would begin to impact a highly levered and vulnerable economy. But there's empirical data that it's happening. I mean, obviously, we've seen the largest wave of corporate bankruptcy filings since the global financial crisis, and that does not appear to be slowing down at all, quite the contrary. And then on the consumer front, the credit situation just goes from bad to worse. There are a few anecdotes that we got last week. I mean, you have to really stay on top of these stories because they come like machine gun fire. But like Redfin, for example, we're feel like we're on the cusp of deflating the housing bubble, which is another huge topic, but
Yep.
obviously something that doesn't help the backdrop at all. Redfin reported that in April, 1 out of 7 housing contracts were canceled. So, and that was, I think, the highest level since they started tracking the data in 2017, other than during COVID when you couldn't, go out and buy a house or do
Right.
it.
And I'm sorry, Steph, is that then on existing home sales?
Yeah, I think it's probably new and existing. It's just total home contract. So if you go into contract on a house, I presume whether it's new or existing, and then you decide to walk away, that's what they're tracking, I would imagine. I can
Okay. And,
I
and
can
just the
find
reason why I
out.
asked was because I know I'd heard a year ago or so on the news side, the builders were reporting they were seeing an
Yes.
increase in people who were basically backing out, right, for financial reasons.
Yes. Yeah, like
But
Pulte and those other home builders, right?
exactly. But I'm assuming Redfin they include also the universe of existing homes. So that's meaningful, right? Because
Right.
it's
It's
not just the
probably
builders.
predominantly existing homes, I would guess.
I would
Um,
too.
yeah. So that stat was a little off-putting. Then auto repossessions, Cox Automotive reports in April, again, highest level in 17 years. So if you do that math, that's the highest since 2008, the Great Recession. And then the last thing that kind of people will debate whether it's a positive sign or a negative sign. I take it as a negative sign given what I'm seeing in terms of the stress on the consumer balance sheet. Home equity cash outs in the first quarter rose 22%. That's the fastest pace, again, since the fastest quarter since the housing bubble burst, since
Hmm.
2008. So it strikes me that if you have waited all this time and you're now deciding to take equity out of your home, it's probably because you've already run up your credit card and you don't want to pay 22% interest rates on that any longer. And you're already struggling because your auto loans are delinquent, etc. And so taking out some equity from your home is probably the last desperate act. Um, but time will tell. Either way, that those three little nuggets kind of give you a sense that the stress on the consumer isn't ameliorating, quite the contrary. Um, and why would it be improving? We did see in Friday's employment report more robust wage growth. But when you talk about the level of employment, I don't want to get too wonky on it, but if you dig through these details here, first off, there was a massive gap between what the household survey said and what the payroll survey said. Not the first
Right.
time we've seen it, but almost a million jobs. It was 830,000 jobs, where the household survey was up, what, 139, and I'm sorry, the payroll survey was up 139, and the household survey was down 660
Hmm.
something or other. So massive disagreement between those two. And one month, it's hard to put any real emphasis on one side or the other. But over time, the household survey has been the better measure. And then, so there's reason to be skepticism about the level of employment, even if you thought that 139 looked stronger. There's a caveat there. The household
Right.
survey.
Well, and let me just note a couple things there. So, yeah, we kind of returned to our old ways in this latest report, right? So the headline number wasn't bad. In fact, it was a little bit higher than I think expectations were. But to your point, you dig under there and yep, that gap has returned between the establishment and the household survey. And yep, all of a sudden we're seeing a loss in full-time jobs again. So
Yes.
the only growth
Yep.
was in part-time jobs, but it was actually only very anemic growth in part-time jobs as well. So there really wasn't a lot of real jobs growth. Um, but also, we saw material revisions of all the previous data,
Yes.
right?
100,000 almost downward.
Almost right, exactly.
Yep.
And so if you kind of look at the order of magnitude of revisions that they made to all the previous data,
Right.
and you say, a lot of people are saying, well, okay, then this number, which was quote unquote beat, is probably highly likely going to get revised down next time. And
Right.
if we revise it down by the average amount the previous months have been revised down, it's going to be a sub 100 number, which would be a really disappointing number if that had been released, this past week. So, there's a lot of room, as you're saying, to be
Yeah. Skeptical.
suspicious of any claim that, yeah, the jobs market's looking strong right now.
Yeah. And the other thing that was very suspect about it, well, there one more thing on the household survey, um, they impute this birth death amount of jobs that were created magically by businesses that haven't yet established payrolls or whatever. So that imputation was more than prior Mays. So it served to lift the number even more.
Right.
It wasn't massively higher, but it was higher at a time when you would think, if anything, they'd be shaving that number lower, because who's saying, oh, I don't know what the tariff outlook is going to be. Let me start a new business and stick my neck out. You'd
Yep.
probably be sitting on your hands if you were thinking about starting a business and waiting for more clarity. The other thing is this, I don't want to get too much time on this stupid report by the BLS, but the unemployment rate obviously was only 4.2, because while the household survey went down 660 whatever odd thousand, the labor force fell the same amount. So it kept the unemployment rate steady. You had a 600 plus thousand drop in the labor force, which is hardly what you could call a bullish sign. I mean, if you think that's bullish, then basically everyone should leave the labor force and we'd have 0% unemployment and everything would be great. you know,
Right. And,
so
and the flip side of the labor force number going down is it means the number of people outside the labor force goes up, which means you just have a lot more people at home sitting on the couch not looking for jobs.
right. And the
That's
question that I raised, and who knows if we'll ever get the answer, is what explains that massive drop in the labor force, At a time, again, as we just talked about, where consumers can't even pay their bills. Like they're delinquent on everything, credit cards, auto loans. Their cars are being repossessed at the fastest rate since the Great Recession. Who's quitting their job in this environment? Nobody. In
Yeah.
fact, if you look at the JOLTS data, which came out earlier in the week, the quits rate has absolutely collapsed, which is
Right.
what you'd expect. People are nervous, they're anxious about the outlook. They may hate their jobs, but they're like, I need to collect this paycheck. So that doesn't square at all with the idea that 600,000 people just up and dropped out of the labor force, unless it's illegal immigrants who are afraid to say we're in the labor force because they're afraid that they'll be reported and whatever. So in the household survey, they just call and ask, are you and how many people in your household are employed? Who have you worked so many number of hours, in the last period of time? So they don't ask you, are you legal or illegal? But if you are illegal, given the background right now, you might be disinclined to answer that survey correctly.
Correctly, and I agree. Although I would think if you're illegal in this environment, you're not answering that survey. They're
Right. Yeah.
calling to say, "Can I talk to you about your job?" And you were saying, "Click."
Right.
So I would think they wouldn't even be appearing in the data that much, but we don't
Maybe.
we don't know for sure. We're just
Yeah.
guessing here.
But
Yeah.
there's something wonky there. It just doesn't add up that you had this massive exodus from the labor force at a time when people are struggling to pay their bills, and the
Yeah, no,
JOLTS quits rate is collapsing. Like that just doesn't make sense to me.
Totally agree. And folks, I'm sorry, I'm going to give myself a pat on the back here, because 2+ years ago, when we had the great, what was called the Great Resignation, right?
Uh-huh.
When quits rate was at an all-time high because everybody was saying, take this job and shove it. I got plenty of options and I've got money sitting in the bank and I don't have to pay my car loan or my student loan or my mortgage right now because of all the forbearance programs. I did say, look, this is going to eventually devolve folks into the great, please don't fire me movement,
Yeah.
or please may I have my old job back movement. And I think we are now there. And I think we're probably going to continue to head into that territory for a good long while here. Let
That's
me
what I
apologize
had.
to the audience for real quick, just for one other thing, Steph. I forgot to mention at the beginning of this video, we are not doing this live this week, which is
Yeah.
probably now abundantly clear to folks. Reason for that is we had some scheduling challenges that we had to put together. I'm sorry, folks, so we won't be taking questions this week, but we'll pick it back up in 2 weeks with the live questioning. So sorry, Steph, you were going to add.
You're too gracious. Yeah, the blame is fully on me because it's my scheduling issues that are constantly throwing a wrench in things. So send all of your hate my way. And next
Not
time,
at
I
all.
promise
Not
we'll take a lot of questions and I'll have tons of time. But apologies for that. No, what I was going to say on the quits rate is, I'm a nerdy chart girl, so I like to look at relationships. And when you were talking about the idea that the great resignation was going to turn into, can I please have my job back? Um, I had that chart that overlays the Wilshire, or basically the total market cap of the stock market versus the quits rate. And what you see is that they move together. So when you're feeling wealthy because your equity portfolio is moving higher, your
right.
401k is, or your inclination to quit your job is much higher. So a lot of that take this job and shove it was a function of not just the COVID stimulus money, but the fact that markets had gone parabolic. So people felt like they had the financial latitude to quit. This is interesting now because that chart literally looks like this. So the stock market continues to go up and the quits rate is absolutely plummeted. And again, to me, that underscores the level of duress that the consumer is under. That it's probably, obviously the consumers who are fearful of quitting their jobs aren't the same people who are enjoying the levitation of
Right.
financial assets. But you've never seen a breakdown like this on that chart before over multiple decades of history.
What that suggests to me, Steph, is so people were quitting during that time because they felt like they had a lot of other options. But obviously, a lot of people were quitting because they were taking early retirement. Like,
Yeah.
oh, my portfolio hit my goals years sooner than I thought, right? Because of all the juice from the COVID stimulus. Um, and so what's interesting is at some point, well, let me put it this way. Those people, I think, are able to continue to remain retired because stocks are back near all-time highs, right? But it does beg the question that if we were to get a material stock market correction, I'm sure these people were sweating bullets back in March and April,
Yeah.
right? Of like, oh my gosh, my portfolio is down 20%. I might need to go back to work, right? Now, things rebounded so quickly, I don't think those people had to take that action, but it does show you the vulnerability of the labor force here to a stock market correction because, as the quit rate is showing us right now, is nobody wants to leave their job because they're hanging on just trying
Yeah.
to make their bills. What happens if all of a sudden you get this wave of retirees being forced to try to unretire?
Yeah. Or Bitcoin millionaires who suddenly realized, sorry, I had to throw that in there,
You had to
but
throw that in. But I mean, look, I
oh
mean, how
my
many
God.
Bitcoin millionaires are there? It's relative to the
I,
retiree base
I
is
know.
very
Also,
huge.
I'm
Yeah, I know, but
really
I mean, I'm just saying, I mean, it's you could see the unemployment rate go from 4.2
to
up by
six in no
1%,
time.
2%,
Yeah.
3% if those people had to all of a sudden try to come back into the workforce.
Yeah, absolutely. Yeah, that's what I was going to say is all of a sudden that labor force would expand and the unemployment rate would shoot higher for ostensibly good reasons that people want to work, but really out of desperation. So absolutely. I think we've bludgeoned this employment report to death, don't you think?
Well, not quite yet, actually. I'm going to bludgeon it just a little bit more. And you know, going back to the original question of recession odds. So one person who is still saying, "Look, I think a recession is unavoidable at this point," and maybe he's sounding like a lonelier voice out there to the Wall Street Bulls right now, but that's Lacy Hunt. And I
Okay.
just recently did a report with Lacy, and the thing that he's got a lot of data to support his thesis here, but the one he really hangs his hat on is money supply.
Hmm.
And he doesn't just use M2, he also uses ODL, which is,
ODL.
yeah.
Yes.
Um, and he kind of munges the two together. And this is because he's a senior economist. I mean, he really understands the data very, very well. And basically, there was a period of time at the beginning of this year where the money supply, which had been declining in 2024, which is why Lacy was ringing the bells. He's like, you can't have basically expanding economic growth for long with a declining money supply. They're two inversely correlated. But then the money supply started to increase in Q1 of this year, and a lot of people who had been listening to Lacy were saying, "All right, well, Lacy, your thesis is negated. Money supply is going back positive again." And Lacy's basically saying, "Yeah, but that was artificial. That was because of all the tariff front running that was going on. You had all of that." Uh, there was just a ton of borrowing that companies were doing to get inventory in before the tariffs were
Mhm.
applied.
Mhm.
And that now that we're past that, he's already beginning to see in the near-term data that actually money supply has turned down again, and the pace at which it's turning down is accelerating. And he thinks that, basically by pulling so much purchasing activity in early is we're creating this air pocket
Yeah.
now.
Yep.
And so he just basically saying, look, I don't see mathematically how we're going to avoid this. So it's quite compelling when you listen to it, folks. If you
Yeah.
haven't watched the video with Lacy yet, go watch it. There's a lot of people who will say, look, Lacy's been leaning on that for a long time and the recession hasn't materialized. And Lacy would be one of the first to admit that. But he's a man who understands economic theory better than almost anybody living today. And he cannot think of a reason why that should not eventually matter. So that's one big reason. Just feel free to comment on that in any way, shape, or
Yeah,
form. I
no,
got one other
absolutely.
thing.
So my one thing with Lacey's analysis, I totally agree with it, is that I don't think he needs to apologize for claiming he missed the recession because, as I mentioned earlier, I think we have been in recession, and it's just not evident in the one data point that people actually view as indicative of recession, which is this manufactured real GDP report that has all kinds of other stuff in there, like you know, intangible assets and intellectual property and all this stuff that they can just make up numbers for. Um, but that being said, I firmly agree that we had this huge pull forward in anticipation of the tariffs of economic activity, and that there will therefore be a give back. And I think you're seeing it already. I watched the weekly industry retail sales report, comes out every Tuesday. And retail sales absolutely took off in late March, early April, as people began to anticipate, oh my God, I better buy stuff now because these tariffs are going to be 100 whatever percent, and I'm not going to be able to afford it. And then we found out last Friday after payrolls, consumer credit card borrowing ramped up in April as well,
Hmm.
because how else are they going to pay for this stuff? Not like they had a change of jobs where they suddenly got a lot more money. So they had to run up the credit cards to buy these items. You've
Right.
now
And
seen,
home equity.
and home equity, apparently. And this today, they reported the latest retail sales weekly, and it's collapsing. So it surged at the beginning of April, and it's just come a straight line down in the week since. And so I think you're already seeing that in the weekly chain store sales data, and we'll find out. It may be too early for it to show up in retail sales that we get next week. Who knows if it'll get in that number. But the long story short, I mean, I think that clearly there was activity pulled forward. We saw that in the first quarter GDP report in terms of the purchase of capital of equipment by corporations. Massive increase in what, people looked at the increase in capex, but it was all equipment, presumably that they were importing from Asia in anticipation of tariffs raising those prices. And I think it was like a 22% increase. And so that was a huge contributor in the first quarter. So there will be a give back. I totally agree with him on that. And then the question is, are the markets going to be shocked about that? Or are they going to act like, oh, we are, we knew there was going to be a give back. I have no idea. I feel like this stock market is so far ahead of itself, and that the attitude now, at least what I hear when I'm listening to the financial media, is, this is it. That was a little blip, and now we've got smooth sailing ahead of us. And this idea that we're going to have sort of a second half slowdown doesn't have the same audience, let's say, than it
Right.
had a few months ago.
So it's totally true. And what's interesting is, you mentioned technically you wouldn't be surprised to see things move higher before they move lower. A lot of the technical guys that I've been interviewing recently, not all of them, but a lot of them do say, yeah, the market's got a bullish bias from here. And they think it's more likely to run to the upside. We're in such a, what I call a news bomb driven time in the markets now, where almost more than anything, they're just reacting to the next big revelation, and we're getting a ton of them. But the uncertainty that has been driving the action for the past couple months, um, it does seem that it's likely to get resolved, like more likely to get resolved going forward now. So there are trade deals that are going on, and even if you're a skeptic, the headlines that are coming out just today, second day of talks with China. Lutnick is saying they're going well. Now, of course, the administration is going to try to put whatever polish they can on what's going on here. But the fact is that we are meeting again with China, and we're both still at the table. And news is dribbling out that, okay, yeah, we're probably going to get some give on rare earths, and we just gave them some
Mhm.
gives on chemicals. A headline came out about an hour before we jumped on here, Stephanie, about India and about how those talks are coming along well. So, if and as these trade deals start getting announced with the big 20 companies or
Right.
countries,
Countries.
that's only going to probably give good news to the market. Okay, yep, all that uncertainty we were worried about, it is starting to come off. Trump, seems to be delivering on these. There's a lot of uncertainty right now about the big beautiful bill. But if that gets passed, it may not get passed in its current format, but as I've talked about with many people recently, highly likely some version of it's going to get passed, because I don't think any sitting congressperson really wants their name on the biggest American tax hike in
That's,
history if the tax cuts aren't made permanent, right?
yeah.
So again, I just see more odds that uncertainty is going to get removed here. So in the next couple of months, that may provide less and less weight holding the market back, right?
Yeah, absolutely. But certainty isn't always positive, too. I mean, removing the cloud of uncertainty is helpful. People will have information that they need to make decisions, especially uh, people who own businesses and are thinking about hiring and expanding, et cetera. But what you know is that if you're in any way connected with things that are going to face a tariff, that either your cost of goods is going to go up or your cost of labor is going to go up, because you're either going to be reshoring production here or you're going to be paying extra to bring things in from wherever you're bringing them from. So you're either facing higher cost of production or labor, which is a problem for margins unless you can pass those price increases along. And to pass those price increases along, consumers need more income with which to absorb it. Now, if we pass the big, beautiful bill, they won't have a tax increase, but it's not clear they're going to get more of a tax cut. I think that's still very up in the air as to whether they'll actually be able to get the no tax on tips and all of the extras that Trump was hoping to get in there. So basically, you're just saying you folks are you're status quo. It's just going to be kind of more the same. You're not going to face a tax increase, but nothing materially is going to improve in terms of your tax treatment. At the same time, you're probably going to be facing higher costs, or you're going to, you know, find that there are less jobs because companies that are having to pay more and having their profit margins squeezed are going to try to do more with less people because they've got to find a way to offset that hit to margins.
Yeah. Although on that, and look, I don't disagree with anything you've said. And I've said many times, even if the administration is successful with its policies, best case scenario, there's still going to be, you're going to take a lot of the cost up front before you see a lot of the benefits of it. So
Yep.
reshoring, a great example, right? Um, but one of the things the administration would potentially say is, yes, Stephanie, those things are all likely true. One though is corporate profit margins are like the highest they've ever been, practically,
Right.
right? So those
Yep.
guys can eat some margin at this point. Then not the end of the
Right.
world, right? And they can probably eat some margin without having to resort to mass layoffs. TBD, depends on the industry, depends on the company.
Right.
But if there was a time for them to eat margins, this is a good time because the profit margins are so fat. Another element too is presumably, who knows, but presumably coming out of these trade deals are things like, okay, so yeah, we're gonna put you escape the 60% tariffs, but you're gonna get a 10% tariff on your goods, so that it's gonna go up, right?
Right.
But we'll bring it down from 60 to 10, and as part of this, we're gonna give you, lots of cheap natural gas from America, right?
Uh-huh.
So there will be additional demand
Carrots.
for other American jobs, right? So like, yeah, one industry might get hurt, but another industry might need a ton of people all of a sudden working for it,
Right.
right? So there might be some of that. And look, I'm not trying to sell sunshine here at all, Steph. I'm just saying that there's an argument to be made that it might not be all bad, even if, tariffs get pushed here.
Oh, absolutely. No, I mean, I think this is all tremendously constructive for the long term, but the transition period is going to be, as you phrased it a lot better. You said the costs will be up front
Right.
and then the rewards will come later. And I think that's the important concept, that the markets are discounting. They're looking over the valley of the upfront costs to
Yeah.
the nirvana on the other side, which is fine, except when those costs hit. Yes, profit margins are extremely high. They can afford to come down. But based on the market valuation, any decrease in margins leaves the stock market dangling out there like a giant matzo ball. It's just hanging out there on a valuation standpoint. So what this market needs is earnings to grow to provide the support on, that's not underneath it right now. It's just air underneath this market. At these valuations. So what it really needs is either significant earnings growth and or a Fed that's just going to pump liquidity and make the fundamentals irrelevant. And neither of those two things seem to be forthcoming. But I guess, Adam, where I kind of get off the rails a little bit is that I step so far back and look at this from a secular standpoint. And I know you've talked to Michael Every about the mercantilism idea. And so I think about it, and you and I have discussed this about the end of the era of globalization. And the calling card of the era of globalization was what Greenspan described as the Great Moderation, where we had these 4 decades basically of steadily declining inflation as we were able to have access to cheaper goods and labor all across the world, which in turn allowed interest rates to keep coming lower and lower and lower. So the Great Moderation, as a consequence of lower inflation and lower interest rates, the economy are we basically in the process of globalization exported our business cycle to the rest of the world.
Right.
Before that, the recessions and expansions were a function of inventory swings. So once we started really expanding this shift to globalization, our inventory swings became their inventory swings. We
Yeah.
didn't have inventory swings here. Taiwan was jerked all over the place.
Yeah.
And we had the bliss of just enjoying cheap semiconductors at low prices and with low interest rates that afforded us an opportunity to financialize our economy rather than industrialize our economy. We kind of offshored the industrial part of the economy and had the luxury of focusing on sort of the financialization of the economy. And so in broad, these are huge themes, but in broad brushstrokes, I think that we're reversing that. Obviously, it will be a multi-decade process. It's not going to happen in the next few months or even years. But at the margin, inflation will be higher, interest rates will be higher, business cycles will be more profound here. So we'll have volatility in the economy that we didn't have before. The Great Moderation is ending, and we're going to import back the business cycle with higher inflation, with swings in inflation and interest rates and all of that, to the detriment of the financialization that
Jim.
we've done. So these are super big themes that you can't really position in a short term, a portfolio. But things like gold, and I hate to be a broken record on it, makes sense in an environment where you see this kind of transition happening. Now, you're totally right. There will be industries and sectors that will do very well in this new framework, but there will be others that are struggling to adjust, and none more so than Wall Street, which has had the easy runway of, this tailwind of low inflation, low interest rates, and the freedom to just basically pursue financial engineering till the cows come home, because all the plebeian tasks of actually building stuff and shipping it and whatever was being done outside our borders. So I think that's all ending, and that's a concept that I think people need to start kind of wrapping their heads around.
Heads around. It's such a great point, and I think there's maybe a whole like show around this type of topic stuff.
Yeah.
You mentioned so many things there that I'd love to really dig into with you, but I'm looking at the time. We got a few other things we got to get through before we have to hop off here. Few things though, based on what you noted. One, just to underscore Michael Every's, mercantilist point of view is to your point about some parts of the economy do well, other parts probably won't. In a mercantilist country, the free market is not the be all end all. It's the nation's best interests, and so those running the country will intervene in the free markets at time to say, you know what, we really have to feed this industry
Hmm.
for our strategic national security needs, and this industry is going to pay the price for that, right? We're going to steal from here to feed here, right?
Hmm.
And certainly, this administration at least has given lip service to Wall Street's had a good run. Main
Right.
Street's going to be the focus going from here. We'll see what happens, but that seems to at least be their prioritization.
I would say I think that
Oh,
it's not that they're trying to reward Main Street versus punish Wall Street, or they're not specifically trying to punish Wall Street, but I think what they understand is that their efforts to pick up Main Street and revitalize Main Street will, for the reasons I just outlined, by almost by definition, come at the expense of Wall Street.
right.
And
And
they're
I think they're saying they're okay with that. If it
they are
comes to
okay with it.
that, yeah,
Exactly.
yeah,
Exactly. Not that they've got Wall Street in their sights, but they just realize there'll be collateral damage, and that's totally acceptable to them.
Right.
And
Because we need to have some sort of manufacturing base here to have more resiliency and whatnot. As much as the Wall Street guys would love business as usual to continue,
yeah,
we have to do this for national strategic
strategic.
purposes. And
Yeah.
if some big Wall Street banks make fewer profits as a result, nah, you know what? That's a price we're willing to pay.
But it
Oh,
also gets
yep,
to your concern about the bifurcation of the economy. You know, this is an effort, I think, to narrow the gap between the high end and the low end and lift the low end and the middle class up so that we prevent civil unrest and all the awful stuff that could happen if we continue to let things go as they are.
well, I think it's exactly true. And I actually think it is the building social unrest that actually put this administration in the
Yeah,
first place to have that priority, right? They went to the voting
agreed.
booth and said, "This is what we care about," right? I mean,
Yep.
it is sort of fourth turning-esque in that way, right?
Yeah,
I
people
also want
like
to
to
know
say Trump that Trump's the one who brings this stuff, but he was elected because of all these things we're already
exactly
building.
the forces of the moment thrust Trump in there. It's not that
Correct.
Trump
Yeah,
created it all from whole cloth.
agreed.
There was also just one other point. This is kind of tangential, but this again is something I'd love to explore with you more deeply in a future discussion. Um, Vice President Vance was speaking to like a Council of American Innovators or something like that, maybe a month ago or so. Um, and he talked about how globalization and the financialization of America and us being able to export I can't remember your term, but sort of the plebeian or pedestrian stuff that
Right,
just,
right.
um, it kind of made us a bit lazy.
Hmm.
So we were able to basically engineer higher corporate profits and higher asset prices, and we didn't have to work as hard innovation-wise. And I mean, sure, there were plenty of innovations that have happened over the past couple of decades, but basically there could have been a lot more if we really had to do the hard work of innovating and driving economic growth, on a real basis versus sort of artificially by getting our costs down artificially by just taking advantage of this cheaper labor force. So it kind of part of his story was like the reshoring and whatnot. Yes, there are going to be some growing pains and transition pains and stuff like that. And maybe we will have a higher cost of production, but then maybe we're going to be able to pay people more and all that type of stuff. But one benefit of this may actually be sort of more real economic growth going forward and more real advancement in
Innovation.
innovation. Yeah.
Yeah, yeah. No, it sounds right to me. I mean, it makes sense. We basically become experts at shuffling paper, or in this case, digital paper.
Digits. Yeah.
Yeah. So doesn't strike me as a particularly inspirational way to
Well,
live.
it doesn't. And I mean, you're probably like me, Steph. I mean, I talked to a lot of people when I was first, starting my first job back on Wall Street back in the mid 90s. And, people would, yeah, I'm basically a paper shuffler, right? I mean, that's what I
Yeah.
do for business, right? And I do for a living. And they made a ton of money at it and they still do. And so, it always struck me as like, doesn't really seem like a sustainable way to run your society where your people who are most rewarded are people who are basically not creating any real value, right?
Yeah. Yeah.
Yeah.
No, I agree.
All right. Well, look, we got a few more topics to move to, and I still actually need to get back to our original one about recession because you said that, where you go off the rails is, when you look at some of these things that you just don't think the math adds up on. I'm going to try to take it really off the rails here. So in addition to Lacy, I recently interviewed Joanne Shu, who is the research director at the University of Michigan.
Oh yeah, yeah.
Yeah. And I'd interviewed her about a year ago, and it was interesting to see how much more concerned she is now about the confidence data that her firm collects, because there's been a marked deterioration in confidence since the start of the year.
Mhm.
It's for a number of reasons, but the biggest driver right now is uncertainty around trade. And it's interesting, like I was kind of surprised at how much the average American worker kind of factors those sort of macro issues into their decision making. They definitely, like you said, Steph, they changed their behavior and front ran,
Mhm.
a lot of what's going on here. So they do pay attention.
Yeah.
So they're very worried about their wages. They're worried about even just keeping their jobs, as we talked about earlier. They're worried about stock prices. They actually do worry about a market crash. And two things were really notable. One was we're seeing this kind of everywhere. It's through all striata of the socioeconomic spectrum. So what was kind of new to her this time around is that the affluent consumer that you and I have talked about is kind of been keeping the average up.
Hmm.
They're seeing a market deterioration of confidence in that class as well. They're also seeing it, on the corporate side as well. And so, one of the things I asked her is okay, so soft data versus hard data. Your soft data, now your leading data, right, which is as people have fears, they then change their behavior, and then that eventually manifests in the hard data. I said, how correlated are these surveys with the hard data of the future? And she said, more often than not, they are pretty correlated. So she's quite concerned that we're going to see people rein in their spending, and then that's going to basically start that vicious cycle of, okay, less consumer spending, lower profit margins, more people laid off, more people then worried and retract their spending and more, right? She's not guaranteeing it's going to happen, but she's certainly seeing all
Yeah.
the seeds of that. So we've got that. We've got the stuff going on in the housing market. I won't get into that right now, but I just want to say, folks, I'll be interviewing Melody Wright tomorrow. So that's going to be the video that launches the day after this one, Stephanie. And I just know from reading Melody's recent work, housing market is continuing to get weaker and weaker nationally. So that's another shoe that's dropping here. And again, folks, if you want to learn more about that, watch the video with Melody. But then I want to go back to an interview that I did about a month ago with Anna Wong, who's the chief economist
I,
at Bloomberg Economics. And she talked about something that was increasingly grabbing her attention, which was the repayment of student loans.
uh-huh.
Um, and she was kind of looking at this as like the potential to kind of be the match that lights the fuse that sets off the cascading contagion, because it's the last of the forbearance programs to get removed. It's the one form of debt you can't dismiss in
Distrust.
bankruptcy.
Yeah.
Yep. And you've probably seen the same charts I have, Stephanie. I think I've even showed a few in our discussions where we're starting to see delinquencies. So you can see the delinquency of student loans is going through the roof, right? Because it practically dropped to zero for the past couple of years. Now all of a sudden it's just screaming higher because these are going into repayment and a certain percentage just can't, right? They readjusted their spending, assuming sort of that, or getting used to the fact they didn't have to pay it. They just kind of assumed they were never going to have to pay
Right.
it back. So, but now we're seeing credit card delinquencies increase, we're seeing auto loan delinquency increase, and we're starting to see mortgage delinquencies
Right.
increase. And
Yep.
so, because people have to pay these student loans, because it's the one thing you can't discharge, it leaves left over to pay the rest, right? So you have that element going on. And then the second shoe related to that she talked about was she believes that lenders kind of are overestimating the creditworthiness
Oh yeah,
of
we
many
talked.
borrowers. And we talked about this, right? That there's been kind of great inflation. And so she expects as this ripple of delinquencies and then defaults begins to really propagate through the system, the lenders are going to wake up to this and they're going to start contracting their lending standards further. And then that is going to exacerbate the issue
Right.
these people are having. And you've already said you've seen them tap their home equity, you've seen them go back to their credit cards. As that starts getting tapped out, people are just not going to have any money left over to spend, and that's really going to start to hit consumer spending. So, I mean, you connect those dots, and you're like, wow, it actually gets
Yes.
kind of hard not to see that we could be in a recession later, or that we might officially fall into a recession later this year.
Absolutely. And this is a perfect way for me to give a little plug for people to sign up for my work because I have so much financial pornography related to everything that you just talked about. I mean, I have so many spreadsheets that overlay the hard data with different components of the University of Michigan survey. I've done all that work. And I found that there are two things, I'm going to go through each of the three topics you talked about, but on the University of Michigan thing, um, there's one component in particular that has the strongest correlation with actual consumer spending, and that is their assessment of the jobs outlook. Nothing is more impactful on consumer spending than their employment outlook. And their employment outlook is abysmal. I mean, it's absolutely horrible. Their real income expectations are the worst in history, but that's not even as bad as the employment when you overlay it with actual consumer spending.
Wow. And that's with an unemployment rate of only 4.2%.
And
That's crazy.
right. Another reason not to believe the unemployment rate.
Yeah.
So there's that one. As relates to the student loan impact and the reprioritization, is how I would put it, of uh, all of your debt payments, debt service. Basically, now student loans are going to be elevated above everything else in the list of bills to pay. And as you said, the consequence will be rising delinquency rates on everything else. What I did, because this delinquency data is notoriously lagging, is I overlaid it with a bank's reserves for losses. And I also looked at that relative to the unemployment rate because I wanted to see, like, is this unemployment rate consistent with the level of reserves that banks are holding for losses? And it turns out that banks are reserving at a far higher rate for loan losses than the unemployment rate would suggest they need to do.
Hmm.
So the banks don't buy it. They're not buying the BLS data because they're seeing something on their end that has them nervous enough. The last thing Jamie Dimon wants to do is apportion money to sit idle in a reserve for loan losses instead of buying back shares or lending to some private equity firm or doing whatever he can do to earn some real return on that money. So the fact that they're reserving at this rate is a major red flag, in my view, about what they really see on the ground. And now I forgot what the third thing was.
That's
I
all
feel
right. That's
like
right.
uh, that,
Sorry, I'll note on the banking side of things that Jamie Dimon just said that he didn't put a date on it, but he said we're going to have a credit crisis again at some point too. So,
because of the
the
interest. Yeah, you talked
yeah,
about rates. We're going to have a problem in the interest. Yeah, that's
right. But the point there just being is the banking system is sort of showing us it's got some pretty big concerns.
Yeah, absolutely. I mean, they are usually behind the curve on reserving for losses, and the fact that they're reserving well ahead of what you would expect to see, given the sort of benign unemployment rate backdrop, is telling. But so I do think, again, these delinquency data are very lagging, but I do think that you will absolutely, so I think Anna Wong is right, you'll see a real increase there. That may catch a lot of smaller player banks by surprise, but I feel like some of these bigger ones are probably already trying to get in front of it. But the one thing it definitely will do is cut off access to future credit, which is vital, not just for consumers, but especially for businesses. So that's going to be another problem. And that kind of weaves back to Lacy's comment on the money supply. If credit creation is slowing, all the liquidity, the oil, in the system is starting to run out. You don't have as much lubrication to get this economy growing without all that. So you need a constantly expanding credit pool and money supply basically to keep things going. Or when I say money supply, I'm talking about money plus the velocity of it. So you've got
Right.
to get the turnover rate moving. But basically, this economy requires an ever increasing amount of credit to grow. So when you talk about banks just not increasing credit as much, that alone is enough to slow the economy. They can still be growing their loan books, but if they slow that rate of growth, the economy will slow by
Mm,
definition.
okay. I'd love to keep this thread, but we got to start wrapping it up here. So just to make it real for people here, sounds like Stephanie in the short term, anything's fair game. Markets definitely could trundle higher here, probably for longer than even the pessimists, can imagine. But you feel like reality is going to win out at some point in time. Um, I'm not going to ask you to pick a time frame or whatever, but I guess I will say it probably wouldn't shock you if the second half of this year turned out to be rougher than Wall Street is currently imagining it's going to be. Um, Let me ask you a couple of things real quick as we wrap up. One, just precious metals. Don't have a ton of time to get into it today, but the complex is still doing well. Gold is still doing quite well. Platinum has caught on fire, which is quite nice. But I
Silver
just
is,
want to note, and I want to ask your opinion. So silver has had a price breakout, right? It
yeah.
finally broke through the $35 an ounce level on the gold future, sorry, on the silver futures right now. It's trading around 36.50 or so. As we're talking, it made a run. It almost touched 37 earlier today. Um, do you think that this breakout has legs or not? Because a lot of people have said, hey, when silver breaks 35, there's really not much resistance technically to keep it, from getting to 50 pretty quickly.
Yeah.
A lot of other people are saying, hey, you know what, it's wicked overbought in the short term, and silver's a heartbreaker and whatnot. So, anyways, what opinion, if any, do you have of the silver breakout right now?
I mean, I just laugh at the idea that silver is overbought or gold is overbought or platinum's is overbought, or any of these metals. Yes, they've climbed fast. Silver has had this breakout, but when you look at, first off, I mean, I won't even get into the ownership of precious metals relative to equities or any other
Yeah.
paper asset. It's a joke. I mean, it's microscope, infinitesimal. So there's the idea it's overbought is laughable. And then when you look at things like the relationship between commodities in general, forget about silver in particular, but just commodities in general relative, again, to the S&P. Again, we are nowhere. I mean, the chart over many years, you're like, you can barely discern that there's been any uptick whatsoever
Right.
from
And
where we are.
still very close to kind of decadal lows, yeah, on that ratio.
Yes.
Yeah.
Yeah. So I think honestly, when you did the preamble there about how I felt like the markets could go either way and I didn't want to step in front of it, the one thing I was going to say is I would be sitting here in precious metals, hard assets, and not care about whether the stock market goes up another 10% before it goes down, or whether it goes down tomorrow, or even if it just goes nowhere for the next decade. I don't care because I know that this shift from paper to hard assets is really just getting going. And I think you're just going to be very happy that you own silver, whether you buy it here and it goes down another dollar before it goes up to 50 or whatever happens. I think in the long term sweep of things, people will look back and see on the charts this was the time when you wanted to rotate from paper assets into hard assets and precious metals in particular.
All right, I'm curious on this then, given that comment, Steph. So past times when we've checked in, you've been, sticking true to your gold. I think you actually even added some to the miners last time we talked.
Yes. Yeah.
But a large part of the other part of your portfolio was kind of in the T-bill and chill camp. And I'm curious, based on that last comment you made, are you starting to move more from the T-bill and chill into precious metals at this point in time, or are you keeping the ratios about the same for now?
I think what I'm trying to do is shift more from the metals into the miners as relates to gold in particular. So
Mhm.
I'd prefer to, at the margin, lighten up my gold position and maybe move into silver and platinum and these other things opportunistically, and then continue to try to build my miner position. I haven't done any of that yet because honestly, I need to really force myself to sit down and make these decisions, but
Well,
I've
you've
got a
been
lot
busy
of
with
other
all your
stuff.
moves. Yeah,
I
exactly.
know with all my moving. Um, but so I do plan to do that. I want to expand the basket of precious metals that I own so that it's not so gold heavy and has more of a representation with silver and platinum. But I really am very bullish on the miners more than anything else right now, the gold miners in particular.
All right, Stefan. So I totally get that, and it sounds like you think similar to I do. I think I told you about my analogy of the precious metals complex as the whip.
Yes, the whip. Yeah,
Yeah.
it's a
So
great.
so since gold has moved um, a fair amount, you're now moving up the whip as you expect, the next part of the whip, the miners, to start moving further and faster.
Yeah. And then I
Yeah.
guess what I would do is start moving from the metal, the gold metal that I own, also more into silver, and then eventually do the whip thing there too. Although a lot of the gold miners are also silver
Or
miners.
also, so yeah, yeah,
That may be
yeah.
redundant, but
Yeah,
um,
and that's sort of why I think of silver as the tip of the whip. Like if you're investing in silver, it's
you're out there.
Yeah,
Yeah.
if you're in the mining complex, you probably own many of the silver miners by buying the major GDX, GDXJs.
Yeah.
All right, so last thing I want to try to squeeze in here if we can, Stephanie, is uh, I have so I've got a niece who just graduated high school, and she is a great kid, very self-directed, very smart, and she proactively came up to me and said, "Hey, Uncle Adam, I know a bit about what you do, or I've heard about what you do. My parents, you know, they've got different jobs. They're not super financially literate people. I want you to teach me how to do money." That's what she said.
Teach me how to do money.
Yeah. So she's coming up later today,
Oh
and
my God.
I told her let's do like an hour talk. I don't want to overwhelm you, so we won't go more than an hour. And I've been spending the past couple of days kind of building, the material that I want to walk her through, right? So
Wow.
trying to be very boil it down to the essentials, make it very practical, but try to make it fun and easily digestible, as well. So we're going to have our meeting later on today, and we'll see how it goes. But as I was putting it together, I was sort of thinking, I think this would be really useful for a lot of people who have
Huh.
kids that are beginning to go into the world and, would like to have a better sense of kind of, how wealth is made, right? Most people, I'm sure most kids graduating high school, entering in college, graduated from college, want to make more money, tomorrow as they go out into the world than less, right? So anyways, I'm having fun putting this together. And two things. One, I'm thinking, okay, so I probably should package this in a video and put it on this channel. So folks, if that's something that you think would be of interest to you or, important people in your life, your children, friends of friends, et cetera. And actually, it doesn't necessarily have to be from kids. I know there are lots of adults who didn't have much of a
Yeah.
financial education who probably would like a primer like this too. Um, but anyways, folks, if that's something you'd like to see on this channel, mention in the comment section below, and if demand's high enough, I will definitely do it, especially since I'm already doing the work to coalesce all the stuff together anyways. Um, and if there is enough demand there, Stephanie, I'd love it, and maybe I'm putting you on the spot, but I'd love for you to be like an early reviewer to take a look at it and just
I'd love to.
the first
Absolutely.
draft. Yeah.
Yeah. And I know people who would benefit from getting to see that. So absolutely, I'd love to look at it. I was going to say, I don't envy your task because you and I having this conversation is so easy. Trying to figure out how you even begin having a conversation with what's a 16-year-old about teach me money? I don't know.
I know
Oh
it'll
my
be interesting.
God.
But for one, she's 18, so you got two extra
Okay.
years of development there. But no, and again, the key thing is I mean, you and I we can get wonky and we can talk about one subject for 3 hours if we let
Right.
ourselves. So the key thing is how do you pack it with the things that need to be in there, explain them well enough that the person gets what's going on, but then you can move on quickly to the next topic as well.
Yeah.
So, anyways, I would love your thoughts on that. And also, folks, just a big thanks to this audience. I mentioned out on X that I was doing this and just said, hey, what would you want to put in something like that? Or what would you recommend putting in something like that? Got a lot of great ideas.
Huh.
A lot of validation of things I'd already chosen, but there were certainly things that people mentioned where I was like, oh, I've got to include that too. So that was very useful.
Huh.
So in our last remaining couple minutes here, Stephanie, I wanted to ask you this question, if you're comfortable sharing,
Ah,
which
okay.
is, how did you begin your journey about learning about money? You know, was there something in your childhood, either, a life experience that made you say, I really want to get to learn about money, or did you have a parent or a mentor that
Uh,
just sort of sparked your interest? Like what started you on your journey to becoming an expert in money and wealth the way that you've evolved into?
Well, I was very fortunate. My father was a hedge fund manager, so the conversation around the dinner table was all about money.
Oh, so you really grew up steeped in this. Okay.
Yeah, and to me it was just fascinating. But I would say more than that. I mean, aside from learning about the markets and that sort of, and the more importantly the economy and how that the connection between the economy and markets, etc., was. My parents really instilled the value of working. It
Hmm.
was important that you worked. We didn't get an allowance just for waking up. We had chores around the house. So I had to clean the house every week. That was my job. It took 5 hours or whatever to clean the whole house. I probably didn't do a very good job, but that was one of the jobs. I weeded the garden, and that's how I collected my allowance. Then I worked for my piano teacher in my spare time after school. I would get on my bike and I would drive over there and I would work a few hours sorting through, putting back her music and doing whatever she needed me to do. So I had jobs and I babysat and did all the things that girls do in high school to keep money so that we could go to the mall on the weekend and
Yeah.
go shopping and look for boys. But they instilled this work ethic in me. And then more important than that was after you do the work, you want to always save some of the money. You don't want to spend it all at the mall. You want to try to save some up. And I was going to say, when you first started this topic about what you were doing, that this young girl has the great benefit of being here in an environment where she's going to enjoy the miracle of compounding. And that's
Yeah.
something that, like, you and I haven't experienced in a long, 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 long time. So she's got that going for her, which is tremendous. So just starting to save and experience how the miracle of compounding really works will be very exciting for her because she'll see her money grow and that will incentivize her to keep saving more and more. But that's basically, I think that was more traditional back then that kids actually worked. They didn't, no one handed me money to go do stuff ever, and there was never a question when I graduated from high school on my part or my parents' part as to whether I was moving back home. That was,
Yeah.
no,
Is a
we,
clear no. I think, yeah,
yes, no, on both parties' behalves.
that's one of the benefits of Gen X, which is the benign neglect that we had. The fact
Yeah,
that we just knew, okay, no, that door's not open once you walk out of it.
yeah,
Definitely lit a
absolutely.
fire under us.
Yeah.
No, so thank you for sharing that. What's interesting is um, your, it's there are sort of three muscles you have to build, right? You got to earn the money, right? And it's good that you were exposed early on in life that you had to work for money, right? Then as you learn, it's not what you earn, it's not how much of you make, it's how much of it you keep, right? So then you have to save, right? You have to develop your saving muscle. Um, and I think a lot of kids, especially our generation, probably had some variety of those two things. But the investing thing, that doesn't come naturally to everybody.
Yeah.
And I think it probably really, I'm guessing, you correct me, but it probably really did benefit you to have a parent
Oh,
that worked in
absolutely.
the industry so that as you were growing up, you knew all about the existence of that third realm of, hey, I can not only make it and keep it, but I can actually get it to grow and work for me, right?
Yeah, absolutely. I mean, I still talk to my dad about investing every day, So, yeah, growing up, all through high school, all through college, after graduation, and every stage of my career, So I mean, it's great to have people. It doesn't have to be a parent, but if you have people, if you can meet people and bring people into your sphere that give you those kind of insights, it's tremendous. And you should definitely take full advantage of just be a sponge, learn as much as you can. But then the other thing is you got to be careful too, because you get these brokers who will call you up and want to sell you this, that, and the other thing. I mean, maybe that's not as true in this day and age. You probably get a spam email, but back when we were growing up, you probably got people trying to sell you stuff that maybe not the wisest thing to be investing in. So you have to have a good head on your shoulders, I guess. Some skepticism is always healthy.
Well, absolutely. And of course, that's why you want to learn, right? So that you're not just at the vagary of whatever potential shyster,
Right.
poses up to you. So two things. One, your father must be so proud. And I think that's so wonderful
Uh,
that you guys still have such a great dialogue about it today. And your point about compounding interest, I mean, that is the clear, like if I only had one thing to tell this
yes.
this young girl, I would tell her about compound interest. And really, right before we hopped on, uh, Steph, I just finished up this little Excel spreadsheet that I put together for her showing compound interest that I'm looking forward to us playing with together.
Okay.
And basically, I set it up so that we can just change the inputs in terms of like, well, if you put X away every year, right, and it compounds at Y rate, right, what does it become? What does it look like when you're 20, when you're 30, when you're 40, when you're 50? And she's 18, and her grandfather is 85. So, we can play around with these numbers and then see, well, by the time your grandpa's age, this is what you're going to have. And it's amazing, obviously, because you don't have to tweak things that much before the numbers get really, really big,
Yeah.
when you have that much time ahead of you, right? So I'm hoping to kind of open her eyes to say like, wow, like I don't have to make millions of dollars to have millions of dollars by the time I'm 50, 60,
Right.
70. I just need to put away what actually feels like a pretty modest amount of money. I just have to be very consistent about it.
Yeah. And hope that inflation doesn't eat you alive. But
Well,
the
that's
other,
the, I mean, if I only had two things to tell her, the second is
right.
inflation. So we're going to have that discussion too.
I'll add a third thing that compound miracle of compounding is great when you're saving. The reverse uh, factor, if you start to,
When
take
you
out an
owe,
auto loan or a
yeah.
mortgage or borrow on your credit card, that lesson is equally important. You end up paying, $1 million for something that you really should have only paid 100,000 for 10 years earlier or what. So that's another lesson that's probably important to learn.
That's absolutely true, and it's key to learn at her age because I'm sure you remember, Stephanie. What's the first thing that happens when you get to
You get a
college and you
credit
open
card.
your
Yeah.
mailbox? Yeah, it's just stuffed with credit card offers, right?
Yeah.
They're just trying to hook you really early on. All right, well, look, this has been fantastic, Stephanie. Thank you so much yet again. It's
Thank
always
you.
super fun to do these. For folks that would really like to indulge in their fixation for financial pornography, where should they go?
I love the way you phrased that. You can go to macromavens.com for your financial pornography needs.
All right, great. And folks,
www.macro. Oh, that's so funny.
I
Um,
think that should be the new marketing line for
I
Macromave.
Oh my God. Yes, it's quite something else. So yes, or you can follow me at Twitter at @Pomboy. And I do occasionally post some of those charts on Twitter if I feel like they're worthy of sharing with the audience there. So, but definitely in my weekly commentaries, I'm just full of all kinds of lurid charts.
So, Steph, I'm going to put you on the spot. It's been a while since we have featured one of your write-ups in our Macro Pass
Oh
service for our
yeah.
premium Substack subscribers. If you've got anything, particularly salacious that comes up in
Yes.
the next couple of weeks, if you don't mind, send it over and I'll share it. I'll feature it that week.
I'm going to send over all my lewd and libidinous documents for you. Oh my God. Um,
This might be a record week of signups for both Macro Mavens and for the Thoughtful Money Substack.
oh my God. All
All
right.
right. Well, look, Steph, great as always. Folks, if you enjoy these bi-weeklies with Steph, please let her know by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it. And let me just take a quick second. I was looking at the stats for the YouTube channel, and it's really a small percentage of viewers of these videos that are actually subscribed. And the reason why you want to subscribe to the channel is because you'll be informed when we publish a new video. And I've had a lot of people, especially with the live stream staff, who have said, "Oh, I don't find out about the live streams
Uh-huh.
until after they've happened." Well, if you subscribe to the channel, you get alerted when they start. So make sure you're subscribed and make sure you click that little bell. Even if you're subscribed, if you know you're subscribed, just check for a second to make sure that little bell is clicked on as well, because that's again how you get alerted. So folks, take the 2 seconds to do that. And then, as always, if you would like some help in preparing your portfolio, or at least just getting it evaluated to see how it would fare if the future ends up turning out the way that Stephanie thinks it might, I highly recommend that most people watching this video get that help from a good professional financial advisor, but importantly, one that takes into account all the macro issues that Stephanie has talked about. If you've got a good one who's doing that for you, great, stick with them. But if you don't, I would recommend folks consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill it out. These consultations are totally free. There's no commitments involved. It's just a service that these firms offer to be as helpful as they can. All right, Stephanie, thanks so much. Look
Mhm.
forward to seeing you in 2 weeks, and good luck with your next move in the interim.
Thanks. And next time we'll be able to take a lot of questions, so that'll be nice. And I'll be in my new digs.
All right. Well, I look forward to not having to prepare a lot of questions, just leaning hard on the audience and what they care about.
Yeah, sounds
All
good.
right.
Thank
Well, look,
you
we
so
didn't
much.
see her much today, but give Wilhelmina a big scratch for us.
I will do that. I'm sure she'll catch you on the next go round.
All right. Well, thanks again so much, Steph, and everybody else. Thanks so much for watching.